From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Ferro. So the euphoria of a 20-day rocking rally on the S&P 500 is momentarily interrupted. Let's see what the next 30 minutes do. FedEx's bid, we're keeping an eye on Reddit, up 48% yesterday. For the moment, a little bit of bloodletting after a monster rally. The countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up in the show, a busy week for global rate decisions boosts investor sentiment. The equity rally takes a small breather as stocks flirt with the best week of 2024. And from Nike to FedEx, the latest earnings provide more insight to the U.S. consumer. We begin with a big issue. Fed Chair Jay Powell giving a rally the green light.
He had a chance this week to come out and say, you know what, we think that there's been some, irrational exuberance or over-enthusiasm, and he didn't. And I think that just says the Fed is comfortable with where things are going now. It's difficult not to be constructive given the fact that you had this. So first we had it in December of last year, right? We had all this concern about a hawkish Fed in August and into October. That was pretty much an okay, go ahead and keep buying things.
So let's just reflect on the 5 days and a little bit more Fed speak today. Mike, good morning. What have we got?
Well, we've got a question about how we topped this week. That's one thing, because we had a lot of central bank action, the Swiss making the biggest news of the week. But here's the good news and the bad news. Next week, we'll have a major couple of news events. The PCE inflation numbers that will drive the Fed, and Jay Powell taking questions from NPR. But they're both on Friday when the markets are closed, so you're not going to be able to trade on those. Instead, what you get is today you get Jay Powell any minute now, not going to be making any news. It's opening remarks at a conference. He's going to welcome people to the Fed. And then Michael Barr talks about international monetary design, and Raphael Bostic talks about household finance. No news there. Same thing on Monday, Bostic with equitable development. Then Lisa Cook comes in and talks about, the Fed governor talks about the dual mandate, so there will be some news there. And then Chris Waller, who everybody wants to follow, is doing an unusually late New York Economic Club dinner at 6. Usually they're at lunchtime. The Economic Outlook, that'll get a lot of attention. That'll be the last big trade of the week. The only real numbers we have are some on housing, so it's not going to be a big week for that sort of thing. Right now, what we're looking at is the market's still almost in a tie between July and June for which is going to be the first month for a Fed rate cut. And we still have those three priced in with September and December on board as well. But the question, Manus, is a week from today, we aren't going to know where we are because nobody's trading. But if we go a week and a day, back to a week from Monday, will we still be where we are today? Will there be enough news to change Wall Street's mind, or can you all focus on Reddit and things like that instead? Well, it's always good to get distracted by Reddit. And don't forget, you can always trade Bitcoin. Next Friday, it is one of those markets that's open. There you go. Mike, thank you very much for setting out the agenda. My guests this morning say this. Morgan Stanley's Jim Caron weighing in on the markets and the reaction, writing this. They unleashed animal spirits by signaling tolerance of higher inflation, while at the same time upgrading the growth expectations. Jim Caron, Soc Gen, Subadra Rajappa join me now for a discussion. Jim, let's take it straight to you. They've unleashed the animal spirits. So 9 basis points down in the bonds, 20 record highs in equities. I mean, this is a fairly punchy week for risk. Do you just not fight the Fed and embrace this next evolution of bullishness?
Well, it's a great question. Thank you for having me on your show. Look, the most impressive data point for me this week, yes, the Fed was important. Yes, it's super interesting that equities are making new all-time highs. What's most important to me, or what's most interesting, is that 10-year Treasury yields actually didn't go up. They actually went down, despite what would be thought of as somewhat inflationary, somewhat very pro-cyclical, pro-growth, where the Fed is running growth rates above their potential estimates. So they've got growth expectations of 2%, over 2% over the next 3 years. Yet their potential GDP is 1.8. They do expect inflation to come down, and the market's believing it. If you look at 10-year break-evens at about 2.34%, the market's basically saying that, yes, the Fed has long-term inflation credibility, that they're able to run the economy a little bit hot with no consequence of inflation. So the fact of the matter is that the back end is actually the 10-year yield and beyond is actually believing this, and it's keeping rates low, and that's really what's unleashing the animal spirits. The equity market's just following along. It's a dutiful soldier doing what it's supposed to do in an environment like this.
The dutiful soldier, the equity boys and girls out there might have something to say to you on that. Subadra, good morning. Good to see you in the House. You made a beautiful synopsis. You talk about this is the Fed nailing the landing, the soft landing, and that the markets have been quick to recalibrate. 9 basis points down in the 10-year government bond yields. What scale of recalibration is that? It's not huge, but it's a direction of travel, isn't it?
Yeah, absolutely. Coming into the meeting, I think there was uncertainty about whether the Fed is going to suggest 2 rate cuts for this year or 3. They stuck to the 3, and the market quickly recalibrated to that on the very front end. But broadly speaking, to me, the bond markets are in some sort of a limbo. On one end of the equation, even though, as Jim pointed out, you have an environment where the Fed is supporting the economy, and that should potentially lead to higher growth and higher long-end yields. There's no clear catalyst for a meaningful rise in yields from here on, like we saw back in August, September, and October of last year, when the Fed was leaning a little bit more hawkish, and they were thinking about potentially hiking rates again at the December meeting. And on the downside, really, again, because of the strength of the economy, it's been a struggle for bonds to really rally meaningfully from here, because you really need to see the data break meaningfully for yields to decline. So we're sort of in a tight range, I would say somewhere between 375 and maybe 450 if you look at a broader range. And it's really going to be hard for bonds to shake out of that range meaningfully over the near term.
I was listening to Larry Summers yesterday on Wall Street Week, and Larry had this to say, that he warned that it was bizarre that they had a neutral rate of 2.6%, only an inch higher than where we have been given the growth levels. Let's just listen to Larry.
Still, that the Fed is itchy fingers to start cutting rates, and I don't fully get it. We've got unemployment, if anything, below what they think is full capacity. We've got inflation, clearly even in their forecast for the next 2 years, above target. I don't know why we're in such a hurry to be talking about moving towards the accelerator.
So, Jim, any sympathy for Larry there? And I do listen to Larry Summers. He just wonders, not that they're trigger happy, but that we're in such a haste to get these 3 cuts done.
Yeah, so I have a lot of respect for Dr. Summers, and I think he's very, very smart. But I do disagree with him on this one point. I think what the Fed is really weighing is that they believe that policy levels are very, very tight. If we look at inflation, let's call inflation 3%. The nominal Fed funds rate is 5.5%. That means that you have a 2.5% real policy rate. That's very, very high, which means that the Fed is very, very tight. And the risk to the Fed is that the economy could fall off a cliff because their policy is so tight right now that the wheels can come off the cart very, very quickly. If they stand by and do nothing, the unemployment rate could potentially shoot up very, very high. And that's what I think they're really making a trade-off on right now. And that's the battle that the Fed is fighting. So I don't think it's as simple as Dr. Summers is putting it out there. I think the Fed is really worried that they are very tight and that things could slow very quickly if they sat by and did nothing.
Subadra, do you think that the real rates are very tight, and that is a justifiable reason to comprehend and accept the 3 cuts that are penciled at the moment?
Yeah. So I do think that real rates are high. You look at 10-year real yields around 2%. But really, the point is the Fed could take one of 2 tacks, right? In the past, what they've done is they've kept policy restrictive for a lot longer, and they've been slow to cut rates, leading to potentially a recession. This time around, they're basically telling us that they want to orchestrate a soft landing, and they are very focused on growth, they're focused on employment, and they're ready to act if needed. And that's really the difference in the messaging, I would say, this time around in this cycle, where the Fed is much more keen to nail a soft landing than in past cycles, where they've let interest rates stay higher for a lot longer and then cut aggressively when the U.S. economy actually goes into recession. This time around, they don't want to see the economy going into a recession.
I want to get a quick response from both of you on markets. I know that you say the volatility is going to be interesting over the next couple of months, Subadra, but this is investment grade and high yield. The money has been piling in. It's the first positive inflows, sizable inflows, since the start of 2019. And junk spreads are at a 26-month low, the tightest since 2007. If they're trying to nail the soft landing, do you still believe in high yield, or is it IG over high yield? Subadra, briefly.
Yeah, no, I think that spread products in general look very, very attractive, right? I think when you start going out the risk spectrum, you've got to be a little bit more selective on what kind of credits you want to put your money to work. But broadly speaking, I think IG as well. IG spreads are very tight, but on an absolute basis, you're getting very good returns in investing in credit. So that's really where the money's going.
And Jim, for you, lower quality credit is still attractive for you. You're not worried about the default. Is it more about coupon than default?
Yeah, it's more about coupon than default. So we're overweight the high yield space. We're underweight the investment grade space. Investment grade yields right now yield about 5.35%. It's below cash levels. You're taking on a lot of duration risk for not a lot of extra yield. The coupon level in high yield is somewhere in the high 7% area. Yes, spreads are tight. Yes, we know that. If we get a soft landing, then I would argue that default risks are going to be a bit lower. So the way that we're doing is we're barbelling it. We own high yield and then also high quality front end treasuries. We have a lower duration but higher yield, less interest rate sensitivity in the portfolio, and that's the way that we're positioning.
Okay. Team, stay with me this Friday after the Fed. Jim, Caron, Subadra Rajappa, more work to do. I'm going to give you a quick snapshot. A few other stocks that are moving. You've got to keep an eye on FedEx. I mean, it's a buyback of $5 billion, and that is what has given us a 10% lift there. Tesla is down. Again, more discussion around lower potential Chinese output. And Lululemon, I should say, drops by 13% ahead of the opening bell. Abigail Doolittle is with me to take us through some more detail on these stocks. Abby.
Well, Tesla is down on the day, as you mentioned, Manus, and this, of course, after they reduced car production at its China plant amid slowing EV sales growth and competition from China EV makers. On the week, though, these shares are still set to be higher. Nike, not so much, down 6%, also heading to a down week. Feeling the heat from the likes of Hoka. Sales for the upcoming fiscal year are to be in the low single digits versus the 4% estimate. And the CEO saying big adjustments are ahead. Lululemon down nearly 13%, or down more than 13%. They also reduced their full year sales view, so that growth of 11 to 12% is well below the 19% of last year. This as traffic at U.S. store sales slows. And then FedEx, well, that is clearly the one bright spot there, up 11%. They beat adjusted earnings, but there was a small sales miss. And then, as you mentioned, investors really loving that $5 billion buyback, up about 11% in the pre-market.
Okay, Abby, we'll get to the sectors a little bit later on. Coming up, the latest earnings provide more insight on the U.S. consumer.
What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable.
Soft and stable. That's what we like about the consumer. We'll dig into Nike and Lululemon in a little bit more detail in just a moment on Bloomberg.
Talking a year ago, I would have said resilient, 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 resilient. I mean, there was nothing. What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable. They're softer and they're staying there.
Two retailers begin to put stock back on the shelves, and some more information for us. Nike and Lululemon both delivering what could be called cautious outlooks to the shifting landscape for the consumer. The Nike CEO says this: "We know we're not performing to our potential. It's clear that we need to make more important adjustments." What are those adjustments that he's prepared to make? Poonam Goyal joins me now. Poonam, this was a bruising day of reality, really, about what's called competition for Nike.
Yeah, you're absolutely right. It comes back down to product and innovation. And I think both Nike and Lululemon, what they talked to us about last night was that they need more innovation. The reason for some slowdown in Lululemon's first quarter sales is because they didn't have the right product. Similar with Nike, they talked about bringing innovation back and really pushing the pedal harder on it. They have faced increased competition, so they need to up their game.
And on Lululemon, I mean, the issue is this. It's very interesting. It's about footfall, isn't it, into various stores versus the online and the international position for them.
Yeah, absolutely. Traffic has been a challenge for U.S. retailers in general, but Lululemon has largely bucked that trend over the past few years. The softness that we see in traffic, we think could be temporary for them as they add more innovation and the right product back into stores. I think that was part of the reason why conversion was also light at the retailer earlier at the start of the quarter. So we do think that there's opportunity here. Plus, keep in mind, the real challenge here is the conservative guidance that we've heard from both brands. And that's not something new. We've been hearing that all quarter from other brands as well.
Okay, it's only going to have an impact and a reverberation around the retail space. Poonam, thank you so much. Bloomberg Intelligence, Poonam Goyal on the retailers. Bank of America had this to say about the consumer. Further support for lower income household spending continues to come from elevated bank deposits, including households with income less than $50,000. The monthly median savings and checking balances is around 40% higher than it was in 2019. Jim Caron, Subadra Rajappa, my guest this morning. Subadra, that surprises me. This was the team were down at Bank of America earlier this week. And that really did surprise me about that underbelly of strength. Everybody's come in here and told me about the dissipation of savings, the dissipation of COVID money. Would that surprise you to read that kind of fact?
So there has been a dissipation of savings over the last couple of years. There's been a lot of fiscal stimulus coming in after COVID. A lot of that has gotten whittled down. But that said, almost every, we have an unemployment rate that's 3.9%. Almost everyone in the U.S. has a job and they're willing to continue to spend. So really the savings rate is coming down, but as long as they have jobs, there's a willingness, broadly speaking, for investors to spend. But ultimately, what you are seeing in the U.S. is kind of a haves and have-nots economy, where the cohort that's 40 and under is coming under a lot of pressure. You're seeing rising credit card delinquencies. It's the same cohort that's having to pay up student loans, auto loans as well, and they're also not able to buy homes because of the fact that borrowing costs, broadly speaking, are higher. Rents are high and sticky, so they are whittling down their savings, but not as fast as people expect. Yeah, and is that housing element that the Fed are going to be particularly interested in when it comes to assessing the shelter component? Jim, if it's possible to have a walk away from Nike and Lululemon, you could extrapolate that this is an indication that maybe prices may have topped out, maybe that price gouging will have stopped, and that has a trickle effect potentially in the back half of the year on pricing, CPI, and inflation.
So it gets back to what I was saying earlier, which is that effectively what the Fed is worried about is if we get a rapid rise in the unemployment rate, that is going to have a much, much bigger and broader impact on the retail sector, housing sector, and other sectors. And that's what they want to kind of stop. So what we're observing right now is that wages are coming down. The employment market is cooling, but it's not collapsing. Now, the miracle that we're witnessing at this point is that inflation's been able to come down, but the unemployment rate really didn't skyrocket higher. The Phillips curve would tell you, and this is the model that the Fed uses, is that when you get inflation coming down as much as it is, then you're likely to get an unemployment rate to start to move higher. And that's what's really concerning at this point, where if we do start to slow down, if there is some tension in the jobs jobs markets, where the jobs market starts to weaken and wages start to fall more rapidly, you would see an unwind of a lot of the positive news that's been propping up equity prices and the markets in general, and that could happen very, very quickly. So I think the walkaway, or at least the takeaway here, is that we're skating on thin ice a little bit. Now, as long as things continue to move, and as Subadra is saying, people have jobs, wages, everything is okay. As long as it's a soft landing, I think we get through the cycle just fine, but it's risky.
Look, of course it is. I mean, we had that interruption, didn't we, in January and February in the data. Subadra, can I close off just with the jolts that we had this week from the SMB and from the two hawks on the Bank of England throwing in their call for higher rates? I'm looking at the gilt market. You know, it's on fire. These other global bond markets, we could, and this is a question I asked my guest yesterday, we could have this syncopated rate cutting cycle beginning in June. Everybody has a different end point. From a global perspective, do you think we're moving into a new evolution globally in bonds?
Yeah, no, the global bond market is definitely very, very correlated. The expectation coming into this year was that the Fed is going to be the first to cut and all the other global central banks will follow suit. And really the weakness in the U.S. has just not materialized. So you're looking at an environment where the ECB has moved up its timing for rate cuts and looks like the Bank of England might as well. And the Bank of Japan is getting ahead of that and trying to get out of negative interest rate policy. So you're looking at an environment where the U.S. is continuing to outperform, and you're seeing that play out, broadly speaking, in the timing of when the Fed might potentially cut rates. So we are in a situation perhaps that other global central banks might get ahead of the U.S. when it comes to cutting rates.
Okay, Subadra, thank you so much for joining me this morning. Subadra Rajappa, Jim Caron, my guests on the markets. Coming up, your morning calls, DWS Group's David Bianco joins me at the opening bell. We're going to discuss this equity market rally and the road ahead for the Federal Reserve right here on Bloomberg. Your morning calls. We got to Friday. This is what the street makes of some of the big names. We have JP Morgan upgrading Best Buy to overweight, seeing better growth dynamics, easing deflationary headwinds. Redburn upgrades Verizon to neutral, pointing to strengthening subscriber trends. And finally, Citigroup upgrading Foot Locker to neutral, expecting the retailer to benefit from Nike's new strategy for wholesale products. Coming up, we have DWS Group's David Bianco with me to discuss 3 rate cuts penciled from the Fed and 20 straight records in a row on the cash market. Will that endure? The futures at the moment are pointing perhaps we're about to break the trend. Good morning from New York. Are we running out of steam on these equities? We've had 20 records in a row. Lululemon plunges domestically here. The business is under pressure. Tesla also down as they're potentially going to cut production in China. So for the moment, 5,300, big round number. Right now, this market has exhausted itself for the week. But let's see how we finish at the end of the day. Some other asset classes for you. Rounding out a pretty big week where the Fed has indicated they will cut 3 times. That gives you a bond market. There is no barrier to entry here. 420 is where we trade. We're down 6 basis points. We've moved overall down by about 9 on the week. The Bloomberg Dollar Index, you're looking at the dollar actually on the week up 0.7%. It's set for its best week in 2 months. So again, the steadying of the nerves and the rate cuts, etc., and the uplift to growth has emboldened the dollar. Bitcoin, I just thought we'd give you a flash there. Again, down over 2%. At one juncture, we were down 10% this week. This has been the worst week for Bitcoin of 2024, and it still looks overbought, according to JP Morgan. Tesla's down by 3%. It's certainly one of the stocks we will dig into. When it comes to what to watch, we've got athletic retailers Lululemon and Nike, both under pressure, posting disappointing outlooks for slightly different reasons. Abigail Doolittle is with me to differentiate.
Well, on the surface, both of these retailers put up pretty good quarters, Manus, but beneath the surface, not so much. And right now, we have Nike falling to its worst day since December. Lululemon down 14%, the worst day since March of 2020. So that's the degree of selling pressure. Starting out on that one, they beat again on the quarter, but the sales outlook is seen as being pretty cautious. $10.7 billion to $10.8 billion. That's the range for this year. That's growth of 11% to 12%. When you compare that to last year of 18%, it's just not cutting it. This stock now down sharply on the year. On Nike, they are feeling the heat from some of the new running sneaker companies such as Hoka. They warned that sales will fall to the low single digits this year, this fiscal year that starts in June. Analysts had been looking for a 4% rise in the first quarter, 6% rise in the second quarter. CEO Donahue is saying that there are important adjustments ahead. This as they shift away from some of their more classic styles. Both of these stocks, Manus, now down 10% or more year to date.
Yeah, we're just looking at Lululemon. I'm just looking at this, down 15% at the open. That's the biggest drop since 2020. A brutal day there. Abby, thank you very much. Turn to the biggest, well, the newest public company, I should say, not the biggest. Reddit shares coming back to earth this morning after successfully debuting on the NYSE. It is the fourth largest US IPO this year. Ed Ludlow is with me from San Francisco. Ed, I mean, this was stellar. 70% on the open, 48% up on the close. It's just a moment of redressing the balance.
Yeah, I mean, I wrote about in my column today on Technology Daily that they got their AI story right. And I think coming out of the one-day listing or day one of listing, that's what people are talking about. We're pulling back 3% day two, but this is still a company based on the shares outstanding, valued at $8 billion, fully diluted basis around $9 billion. That's lower than its last private round in 2021, which was a $10 billion valuation. And it's going to be interesting in the days and weeks ahead to see who played the IPO. So, for example, we know that Cathie Wood and ARK bought Reddit shares for two of their exchange-traded funds. 8% of the offering went to Redditors themselves without any lockup or restriction. But there are some lockup and restrictions on some of the longer-term shareholders. How will that play up in the next few weeks and months? And I go back to that AI story. You know, it's everything that the executives wanted to talk about, but it's a very nascent business. And I just reflect in the column, and I'm giving myself a shameless plug, but go and read it on Tech Daily, that if you look at the listings of the last 6 months, whether they are a social media platform like Reddit, an AI adjacent story rather than a true pure play AI story, they're talking it up, and in the first instance, investors buy it. There's no real sell-side coverage yet on Reddit, which you'd expect, but I would note that the New Street Research cautioned that the FTC is already probing the Reddit business to license its data for the use in training large language models. And while they think that that will have a muted impact, it could slow down the pipeline of deals with other AI companies that want to harvest that data. So it's been a fun week, Manus. Happy day two post-Reddit IPO.
Indeed, indeed. And it is expected to grow by 20% this year, as you say. They face some of the challenges in dealing with our data when you are a contributor on there. We're looking forward to your daily newsletter. Ed Ludlow there in San Francisco. Let's turn our attention to the EV market. I just said to you at the open, Tesla stock was having a tough day for the second day. We understand they're going to reduce production in China due to slowing sales growth and intensifying competition. Alex Webb is with me. It's almost like a weekly laundry list of either price cuts, factory outages, union angst. Alex, contextualize growth of EVs in China overall. I mean, this is about competition from BYD at the very heart of it.
Yes, not just BYD, but a range of other Chinese EV makers as well. The Chinese market, actually, unlike much of the rest of the world, is growing at a fairly healthy clip, 17% or so. Tesla itself is shrinking. The first 2 months of the year, Tesla's sales in China fell by 6%, according to numbers released locally. About half of the output of this factory in Shanghai goes to the Chinese market. The Bloomberg reports from its sources that the production is going to go from 6.5 days a week to 5 days a week. The thing that's interesting about this is it seems to herald a bit of a strategy shift. Last year, when Tesla started to see this weakness in the EV market, it started really pushing discounts in order to drive its numbers up. Don't forget, Tesla massively expanded its capacity in recent years with new factories in Berlin, in Texas, and of course in Shanghai itself. In order to fill that capacity, it really started discounting in a big way. This might signal a bit of a pivot, that they are instead looking to cut costs, cut some of their production costs. If that extends to other facilities as well, that would be very interesting and something investors would have to take on board because it heralds a different kind of strategy.
Okay. Alex, thank you very much. Alex Webb on the Tesla move. Let's pivot to FedEx. They're recording the biggest rally in over a year, and this is all on the back of a $5 billion share buyback program, cost-cutting efforts that are beginning to pay off. Simone Foxman is with me. This is a battle between current delivery and future promises on cuts, isn't it?
Yeah, I mean, really, this was meant to be a verdict on FedEx's broader cost-cutting plan, and analysts really cheered by what they're seeing so far. Remember, this plan meant to restructure the delivery network. They've lost about 22,000 jobs in the last year or so. Efforts to turn around the express business. Analysts largely saying this delivered, and when we dive into the numbers, we'll see earnings topped expectations by 40 cents, coming in at $3.86 a share. Revenue, however, slightly short of expectations at $21.7 billion. That all of this, though, despite some weather-related disruptions back in January. Raj Subramaniam saying, we are making meaningful progress on our transformation. He said there were permanent cost reductions of $1.8 billion. But analysts, despite this rally we're seeing today, flagging some concerns. Morgan Stanley pointed out potential earnings quality issues. Jeffrey said volumes were softer than expected in the ground, even though that's really the way the business is moving. But we are seeing gains here today on an intraday basis. This stock up the most since March 17th, 2023, Manus.
Go FedEx. Simone, thank you very much. Well, stocks are poised for their best weekly gain of 2024. DWS Group's David Bianco weighs in on the rally saying this. Last week, we raised our S&P 500 price target to 5,300 as it's parenting AI. This includes a 15% premium for superior growth potential of digital stocks. David, good morning. Good to have you with me.
Good morning.
There's no doubt about it. There's an sense of exuberance, 20 records in a row. Contextualize what you think AI will grow at. I was looking at what UBS are saying. They expect 18% earnings growth in tech-related stocks this year, and over the next 5 years, about 70%. Does that lay perhaps the firmest foundation of all for Mag 7 and tech in general?
That's right. So AI is real. It's going to help the S&P grow. It's going to help the economy grow. We're still wrestling with valuations, and wrestling with valuations always requires some degree of consideration of interest rates. So what a week it's been, because we've got the Fed on one hand and AI, the theme, the stocks, still reigning supreme. We do think that we're going to see earnings growth out of the S&P 500 this year and next year. We're not very worried about a recession anymore, but we're still of the view that overall earnings growth for the S&P will be about 8% this year and next year. And that is with tech and digital stocks, the AI stocks especially, doing more than 20% earnings growth this year and next year. The valuations expect every bit of that. And if longer-term Treasury yields go up, then the valuations have become even more demanding. So we've got a Federal Reserve that is signaling that it's patient about inflation coming down to its target. We'll see how patient the long-term bond market remains about that. Those who want to be optimistic about inflation solving itself, or even the deficit solving itself through productivity and the supply side being strong and pointing to things like AI, I would say to you, look, even if you believe in AI, these things take time. They'll play out over years. And what you've got going on in the equity market is tremendous wealth creation on rapid PE expansion, on the promise of what will come in the years to come.
So then,
Yes?
let's just pause. There's a lot to unpack there. So
that's right.
So much then is front-loaded, isn't it? It's on the presumption of future
That's
earnings.
exactly right.
That's your job. Your job is to presume where the earnings are going to come from. But if tech is so front-loaded, is that what leaves you at a 5,300 call for this year? relative to some others. For example, SocGen at 5,500. There's a few other outliers up there, but that seems to be the top of where it is. Is 5,300 a conservative call for you? Are you playing catch-up?
We are playing catch-up. We've been keeping up thanks to good stock selection strategies overall, and our portfolio managers doing a good job of it. But we've been a bit cautious on the macro front from a combination of demanding valuations, and not everything's exactly rosy outside of the tech and digital AI world. That said, it's hard to get ahead in this market without taking even more concentrated bets on the leadership and the momentum that's dominated for so long. That's the situation we've been in. We're doing our best to manage around it, point to alternatives. We like healthcare, we like financials, we like small cap stocks. We want to pick out of these parts foreign stocks. Shorter duration bonds are offering still an attractive yield. We're doing our best to keep up with great large cap U.S. equity markets while recognizing that the promise of AI is real, but don't overly count on it or
it almost sounds like you're fighting with yourself. It almost sounds like you're fighting with yourself and that you're looking for.
And we are. Yeah.
You know, you're looking perhaps at Europe, which is on a magnificent run. Japan, which is on a. I don't even have the superlative for Japan. But are they hedges?
Right. We're pointing to those.
Or are they active participatory positions?
They offer diversification, but they also offer attractive returns in our view, and we've pointed to things like Japan and foreign stocks. But it's hard to keep up with the AI leadership.
Yeah.
And often people come back to us, our clients, and say, that's all great, but what about the Magnificent Seven? What's your view? Our view is overall fully valued. There are still stocks within even that terrific group that we like and some that we're cautious on. But the point is this. I think too many people are saying the Fed gave a green light. But I would argue that the Fed's trying its best to ignore the equity market. And if the equity market continues on this pace, it might be the equity market giving the Fed a bit of a red light, because this wealth creation is what's flying against the Fed's efforts to be restrictive and get inflation down faster, and it should get it down faster. And if this equity market keeps rallying, even if it's right to do so over the longer-term outlook of AI, I don't think that's going to help the Fed in its battle this year or even next year, and I think the bond market's going to lose patience soon.
You know, to a certain extent, the equity market ignored what the Fed said. They raised the longer-term neutral rate, albeit incrementally by a small amount. They penciled less cuts for next year than the market had originally anticipated. They upgraded growth and they upgraded inflation as well. So who's paid the least attention, the bond market at the longer end or the equity market?
It's hard to do nuance right now, either for me or the Fed or reading the equity market. I agree with you. I mean, if you look at the details of the dot plot, they're trying to signal that they might not cut as fast or as low as previously thought, and that has a lot to do with recession risk diminishing. But no one, is paying attention to those details. The headline has been they're going to cut 3 times this year. Market should rally, but the bigger issue is really is AI, the right valuation, and when do we see that supply side miracle really delivering, not just for these tech companies, but for the economy and the broader corporate world overall.
David, who am I to interrupt a magnificent party on a Friday afternoon? Yields are dropping. Equities are merely pausing for thought. David, thank you so much for being with me this morning. Speaking of which, we're going to talk a little bit more about the Reddit IPO.
This whole process has made us a better company, and we're prepared to be a public company. I think it's actually been really good for us.
We'll get a little bit more on that stock debut in just a moment. The stock gives slightly back, down 7% at 47 bucks and change.
This whole process has made us a better company, and we're prepared to be a public company. I think it's actually been really good for us. And I think companies that, can go public, it's sort of a duty. It's part of the, process of maturing as a company.
Reddit gets a warm welcome from investors. The shares soared at the close 48% yesterday, above their IPO price of the debut, with AI at the center of the social media's proposition and value proposition. The IPO is the fourth largest this year in the United States, and it marks a rebound after two of the slowest years in a decade. We'll bring in Bloomberg's Amy Orr on this story. So Reddit, I mean, a great deal of excitement around it. The insiders got to sell a bit of stock, nearly $300 million. I mean, it really blew the doors off at the opening, didn't it?
Yeah, it did. And it seems like it's still holding, even though it's giving up some of the gains in pre-market, but it's still well above the $34, which is very important for a lot of people, especially issuers coming forward in the second quarter. A lot of people were just concerned whether Stereolabs is the only exception to the rule, and then whether it's got all the tailwinds behind it, the AI leaning, the microchips and all, and whether Reddit will actually enjoy the same kind of investor reception, and it seems like it does.
What's the pipeline like? I want to make sure that you're busy for the rest. I want to make sure that you're busy for the rest of the year. You've got Instacart, you've had Stereolabs. I mean, you've had momentum shifting. Will it hold? How does the pipeline look? What are people saying to you?
So the pipeline has always been strong, like given that Reddit has been in the pipeline since 2021, and there are a lot of companies in the same boat. And many of them have been continuing to update their filings to make sure that people understand that they still have the intention to go forward. And there are quite a few of those going forward as well. And then, but the pipeline, even though it's very strong for the people who can actually go out in the second quarter, it's still maybe a dozen or so. But I have to say, the moment that Reddit traded and by the minute that it held above its IPO price, like the pipeline just grew longer and longer.
Well, it certainly gives people confidence, but there's also a dynamic that private equity are perhaps being a little bit more under pressure to give the spoils back to some of their original investors so that they can invest again with more significant size at play. How much of that is going to play into the thinking of those when they go to pull the trigger?
So private equity has held a lot of assets, and they've been kind of stuck with these assets for quite some time. And then in the secondary market, since the beginning of the year, we've seen quite a lot of sell down, which means they really wanted to return money to their own LPs. And then, but the only thing, though, is for private equity assets, many of them have quite a bit of leverage, and that's what investors do not like. They want the proceeds to be used to develop the company for further development, to boost the income and revenue of the company instead of paying their sponsors. We've seen Bright Spring at the beginning of the year. It was the first IPO to come. It was owned by KKR. And it's still, the pricing right now, it's still being kind of hampered by investors' lackluster kind of reception towards it.
Amy, thank you very much. As we see Reddit giving just a little bit back in first flush on the second day of trading. Let's get into the sector price action. Abigail Doolittle is with me as ever, side by side.
Well, on the day, Manus, we are looking at a small decline. The S&P 500 down about 0.1%, helping out to the upside. The communication services sector up about 0.7%. Google higher there. We also have some of the defensive sectors, utilities and healthcare higher. Industrials up slightly. Consumer discretionary, not surprisingly, the worst sector, a big drag, down 1.1% on those disappointing quarters out of both Nike and Lululemon. I should say, not disappointing quarters, disappointing outlooks. As for the week, it's a different story. All 11 S&P 500 sectors are higher. The index itself up about 2.5%. And communication services, well, that's the best, up 4.7%. Industrials, the second best, up 3.4%. The worst two sectors still higher, up about 0.7% and 0.6% respectively for healthcare and real estate. So some of the breadth that people have wanted to see for the market rally this week, that is certainly happening as all of these sectors participate in the gains.
Abby, thank you very much. Great work this week. Coming up on the show, we'll set the agenda for you with your trading diet. A little bit of Fed speak today. I'll check in on your trading diary in just a moment. It's worth refreshing our view. This is a break of trend, 20 records in a row. You are just seeing Lululemon down. The footfall in the shops here in the United States is lower than estimated. Internationally, not doing too bad. Likewise, Tesla down, as we understand they're cutting production. So for the moment, this is bullishness interrupted. In terms of the trading diary, this is what you need to know for next week. Monday is the deadline for Donald Trump's $454 million bond. What will happen? The Milken Investor Conference kicks off on Tuesday. Then we understand how the housing market in the United States looks. The U.S. mortgage applications come in on Wednesday. Thursday, Sam Bankman-Fried's scheduled sentencing in New York. And finally, ending the week with the U.S. PCE, all important, and the Fed Chair Jay Powell. The markets will be closed for Good Friday. You can, of course, trade Bitcoin, vicariously trading risk. There's a thought for you. That was Fed Week on Countdown to the Open. I hope you enjoyed it. Do join us next week. We'll leave you with the rest of the team to take you through the rest of your trading day. And Mr. Bostic speaks a little bit later on. We've got it all here on Bloomberg.